Good evening, traders, and welcome to BCI's Evening Market Outlook. It's been a busy day across markets with headlines ranging from fresh developments on trade and tariffs to shifts in geopolitical tensions and central bank chatter. So let's break it all down. First up, let's talk a bit about gold and silver. Gold held its ground in the overnight session, edging up 0.34% to around 3350. Silver followed suit, gaining for the third straight day and settling at 38.20. The support came largely from a softer US dollar and falling treasury yields, which helped boost demand for safe haven assets. But with macro risks still hanging in the background, investors are still staying cautious. Trade remains a key theme today. The US Commerce Secretary confirmed that starting the 1st of August, a base tariff of 10% will apply to countries without trade agreements, a move that's already sparking concern among global partners. While there's hope for a breakout deal with the EU, European officials are preparing retaliatory measures just in case, especially with Trump-era tariff ideas being floated again. Talks with Japan are still ongoing, and Pakistan's finance minister is in Washington pushing for a bilateral deal as well. So trade policy is definitely back in the spotlight. In Washington, tensions between the White House and the Fed are again flaring up. Trump doubled down on his calls for the Fed to slash rates to 1%, blaming the high interest rates for holding back on the housing market. He also wouldn't rule out removing Fed Chair Powell, although reports suggest that's quite unlikely for now. Meanwhile, Fed Chair Voller said he's open to becoming Fed Chair if nominated, and flagged concerns that tariffs could add to inflation, which is another layer of uncertainty heading into the next policy cycle. On the geopolitical front, there's been a flurry of headlines. Iran has agreed to resume nuclear talks with European nations in Turkey later this month, while Russian President Putin met with a top Iranian advisor. Trump steered things up by claiming that Iran's nuclear sites have already been destroyed, though there's been no confirmation on that end. The Russia-Ukraine conflict also remains in focus. The EU announced a fresh round of sanctions targeting Russian sectors, while new price caps were introduced on Russian oil. On the ground, drone attacks knocked out power in Ukraine, which added to some tensions. In Syria, an Israeli airstrike sparked debate with the Trump administration, and in response, Syria announced a ceasefire in the southern province of Suwadia. In Japan, Prime Minister Ishiba's ruling coalition lost its majority in the upper house, a setback for the government, but Ishiba says he is not stepping down. This could steer some short-term political uncertainty in the region. On the macro front, U.S. consumer sentiment ticked up in July, hitting a 5-month high of 61.8. One-year inflation expectations eased slightly to about 4.4%, offering a bit of relief for the Fed. Meanwhile, the U.S. House passed a massive $832 billion defense spending bill for 2026, which could have long-term budget implications. And over at the G20 meeting, finance ministers emphasized the importance of central bank independence, a pointed comment given the political noise lately around monetary policy. Oil prices held firm near $67 a barrel, supported by the new EU sanctions on Russian energy. Diesel markets are especially tight right now, with front-month spreads widening sharply, a sign that demand is outpacing supply as we head into peak season. In the currency market, the political shift in Japan could weigh on the yen, possibly pushing USD JPY higher towards 152. That could also spill over to regional currencies like the Korean won and the Taiwan dollar. In Europe, ECB remained split on whether to cut rates in September, with markets pricing now pulling back from earlier expectations. And that's a wrap for today's market outlook. Thanks for tuning in. We'll be back tomorrow with your morning update. Until then, take care and enjoy your evening.